Well, should we go ahead and start working through the questions we got sent earlier today?
Yeah, that'd be great.
Cool. So thanks for joining. We'll record this too and send it out to the list. I know we've been getting a lot of people asking for the recordings, just as I'm sure people are busy. We got a number of questions that came in through email kind of in advance of the call, so we'll go ahead and work through those. As usual, if we can be of service, or if there's a question that you didn't want to ask on in kind of a webinar type scenario, feel free to shoot me an email at zach@thegreecpas.com and we can discuss your questions there. But we'll go and get started. So if a second home mortgage is used to purchase the short-term rental property, are there any issues with taxing the short-term rental property as a business Schedule C?
Yeah, that's a great question. Yeah, so in terms of taking out like a home equity on your primary residence, so situation is you're looking for funding, you take out a home equity because you have equity in your home. Basically that interest expense then is, you would trace that to the activity where the funds are. And so ultimately, I guess what I'm alluding to is that the interest expense that you're going to incur on that debt, that's going to be a deduction for your rental property. And then in terms of listing it on Schedule C, basically the requirements there for it to be listed on Schedule C is for short-term rental is typically that you're going to have an average use of 7 days or less, or 30 days or less with significant services. So something like turn down service or cleaning the sheets as people come in and out of the property. If you meet those requirements, that's ultimately what you need to do in order to report that on Schedule C. That, and you have to materially participate in the activity. And so when we talk about material participation, it's largely the IRS's like their check for saying like, are you actively working on this rental? So, which is normally the case of a short-term rental. So if you're the one managing it, for example, and you're consistently working on the rental property, you're probably going to hit one of the IRS's thresholds, which is either you got to work on it for 100 hours and more than anybody else, or you need to have worked on that activity for at least 500 hours to materially participate. And so the 100 hours and more than anybody else is kind of hard to do if you have a property manager. You can get to that threshold, but it can be more difficult. So I think that answers the question. Anything else?
Yeah, the only thing I'd add on that, Chet, is just to reiterate what you said. Basically, know where you get the funds to buy the property isn't going to impact how it's reported on your return. It's really going to come down to the nature of that business activity and the specifics of how it's being used. That's what's going to determine how it gets reported. And then you referenced Schedule C. For anybody who's missed our previous calls, basically with the short-term rental, you have the opportunity to use losses that you might incur on that rental to offset other ordinary income without, otherwise meeting the REPS real estate professional test. And that's when that short-term rental falls on Schedule C, which is treated as an ordinary or normal business activity instead of a rental activity, which would fall in a different schedule, Schedule E.
Yeah, great strategy for people who either find good investments in short-term rentals. And so see a lot of my real estate clients look at New Orleans, for example, a very tourist friendly and normal conditions, very tourist friendly location. So it's an example of somebody has a full-time job. They're probably not going to get to real estate professional status in the next couple of years, but they're looking to kind of invest in real estate and take advantage of the tax advantages now. They'll look at short-term rentals.
Cool. And then I've got two questions here that I'm going to ask kind of as one, because I think they're getting at the same question here. But so one is, can you walk us through the sale of a short-term rental property and the tax implications? And then the second is, does cost segregation slash bonus depreciation get recaptured?
Yeah, great question. Yeah, so basically the calculation of gain. So if I'm going to sell this property, I'm going to cash out and I'm not going to do anything other like a 1031 exchange or anything like that with the proceeds. It's going to be, what's the sales price less what was my purchase price Then I have to add back depreciation that I claimed, and that'd be all depreciation, normal depreciation, bonus depreciation. So following the example, if I've sold it for 200,000, I bought it for 50,000, but I already claimed 30,000 in depreciation. I now have $180,000 of gain. The other thing I can add to it is any closing costs on the front end and back end. So normally you're going to pay more when you sell the property, but you usually will have some closing costs when you purchase the property. And then really any improvements to the property. And so any improvements that through other means that we weren't able to write off. So a lot of strategies there to write off improvements around some things that de minimis election, the partial disposition election that we talk a lot about with our kind of our ongoing support package. But that's ultimately the gain, or how you calculate gain.
Perfect. And then similar, so how does recapture work for 1031 versus straight sale of the property?
Yeah, good question. Yeah, so for going back to my example, I could sell, or basically I bought the property for 50,000. Say I've claimed depreciation of 30,000. Now my basis in that property is $20,000. Basis is what we would call basis, is basically what can I use to offset proceeds. And so if I do a 1031 exchange, my basis transfers to the new property. And so if I did a 1031 exchange for a property that was of similar value, basically my basis in my new property is $20,000. Does that make sense?
Yeah. And then the only other thing I note on that is with regards to recapture, that's only going to kick in when you ultimately sell that property. And so that recapture tax is strictly based on how much depreciation you've taken. And it will kick in when you ultimately sell. It's not triggered in a 1031 exchange.
Yeah. The only other thing that I'd note there on depreciation recapture, just because I've seen this for a couple of clients, is they'll try and avoid long-term gains by doing some sort of like owner financing. And so, for example, if I sold the property that had a bunch of depreciation on it, and I wanted to basically let the buyers buy it from me over time for some rate of return, depreciation recapture does kick in 100% in the year of sale, so that you don't get to spread that over a 30-year loan. So that's one little nuance to sales that sometimes people get caught with.
Cool. And then are fees paid to real estate agents and 1031 intermediaries deductible?
Yeah, great question. Those typically get added to basis. A basis in the property because it's a selling cost, and so cost to sell the property gets added to the basis. So I get it deducted in the sense of it adds to my basis. I don't get it deducted now, unfortunately.
Cool. And then just a reminder for the folks that might have came in late, feel free to drop questions in the Q&A section. We'll get to those here today. We have a couple that came in earlier in email, so we'll get through those also, but just as a reminder. And then our next question, so I need Schedule C instead of E for short-term rental in order to shelter activity income without reps.
Schedule C, yeah, great question. Yeah, so most likely yes. The situation in which you could still basically shelter your income for Schedule C would be is if you're actively participating in that property and if your income fell below $150,000. So if I'm somebody with $100,000 in income per year, or we'll say 90,000 per year, just to stay below the thresholds here, and I have a rental property I'm actively participating in with losses, I can claim up to $25,000 of losses against my income. I usually don't see that. Normally the people who are investing in real estate, I'm usually seeing their income is above $150,000 per year, but that is an exception to that rule. But yeah, typically you're going to be looking at short-term rentals situation with material participation, or you're going to be looking at, I need to be a real estate professional. So I'm going for a bigger portfolio of rental properties, and that's kind of my goal.
Awesome. And then we'll turn back to the ones we got in email here. So can international properties count towards reps?
Yeah, absolutely. Yep. International properties, those hours. It's funny because you'd think that there was some crazy different treatment, but from a U.S. perspective, for the most part, A rental property is a rental property. So your rental income is taxable, the expenses that you incur are deduction. For the most part, the rules are the same. Kyle, any nuances that maybe I'm missing? Depreciation?
Yeah, depreciation is the only big difference there. So things like bonus depreciation, which you usually capture through that cost seg study. Bonus depreciation doesn't apply to international properties. And then there's a different depreciation system that's used for anything that's outside of the United States. Generally, the lives on those assets are going to be a little bit longer, and they're required to be done over a straight line basis. So assets in the U.S. generally qualify for different kind of preferred depreciation methods that allow you to accelerate and recognize your expenses faster. Anything overseas is going to be kind of more low and slow in terms of depreciation. But other than that, everything's the same.
Kyle, question for you. Would you still potentially benefit from a cost segregation study simply from the idea of finding a shorter life for some of the assets? So if I could carve out $100,000 for 5-year property as opposed to probably still a benefit there?
Yeah, probably. The only note, it may be more difficult to have this segregation study done because there just may not be resources available in those other countries. I suppose you could probably talk a U.S. company into traveling abroad to do the study. There may be some additional cost involved in that.
Yeah.
Perfect. And then, so I get this question a lot. Can I count traveling to my properties as material participation?
Yeah, good question. Kyle, what is I'll let you go to that one.
Yeah, so the tax courts have gone different ways on this. Generally, they consider travel to not be included in your time. That said, there is a little bit of a special case that you can make the claim that your travel time is included if you have a home office. So if you're doing all of your primary work out of your home office, your administrative home office, where you're doing all the background maintenance for your kind of your real estate portfolio, then you can make the argument that that's your primary place of business, and then anything between that place and then outside of the home that you have to travel is business time, is business travel. So like your mileage and such would be included there. In that space, you could make the argument that the travel to the home itself is part of the management time, is part of your time spent on that property. That said, it's an area where the IRS is probably going to push back if you were to be audited. And if you were on that cusp where you barely met your hours test, I could see them really grilling you on that.
Cool. And then can you discuss the CARES Act and NOL usage as it relates to the CARES Act?
Yeah. I think what a lot of people here are looking for is basically the idea of, can I use a net operating loss now under the CARES Act? And so, yes, you can. You can use it through, I believe, 2021. Can use the net operating loss. And so what a lot of people are doing as it relates to real estate is they're trying to offset all of their income. And so I'm going to make heavy investments in real estate. I'm going to go for real estate professional status. I'm going to do a cost segregation study to generate massive bonus depreciation deduction. Then I'm going to use I'm basically creating enough deductions or enough losses that I'm going to offset all my income and carry that back. And so the carryback is it's a 5-year carryback. Basically, it goes back to the earliest year. And there's a form you file to basically get back taxes from that you previously paid from earlier years. So you have the option to carry it back. You also have the option to carry it forward. Some strategies involved in that. Also, just more so because this is a lot of people are looking at this strategy of like, that sounds really great. Like I want to get taxes back that I paid. For a lot of people, we end up finding is actually probably better investment strategy for them to not do that. And that largely has to do with, so not all cases, but for some people, it largely has to do with the idea that we have marginal tax brackets in the US. And so a lot of my clients will be high income taxpayers. Their federal tax rate alone is 37%. If they're living in a state that has a state income tax, there's an additional 4 to 12% depending upon where they live. So I'm paying a massive tax bill at the highest tax rate. So I say that largely because if I could spread $100,000 across a 48% tax bracket for 5 years in a row, or I could spread $500,000 across a bunch of lower tiered tax brackets, I'm going to end up typically in a better place by spreading out that deduction over time.
Awesome. And then got another question here. So if self-managed, how many short-term rental properties would be safe to justify reps hours, and safe is in quotes?
Yeah, good question. I hate giving this answer, but the reality is it depends. And it depends simply because I've seen people with short-term, with one property that's really like a high use property. It's in a hot location. There's constantly people coming in and out. They're constantly working on those short-term rentals. And so, it's an Airbnb situation. They're sending people codes, get in the door. They're communicating with various vendors. They're participating more than those vendors, but between all the activities that they're doing. And for some people, it's I need multiple properties to get there. And so if I had to give you a rule of thumb, where I typically see it, 2 to 3 properties. That being said, I've seen it with 1 property. Some people, they need 5.
Zach, can you ask that question one more time? I think I missed something in there.
Sure, yeah. So if self-managed, how many short-term rental properties would be safe to justify the reps hours?
Got it. Okay, so generally with your short-term property, because it is the short-term in nature, if you are providing enough services that property is going to fall into Schedule C, it's no longer going to qualify you for reps. So those short-term rentals on Schedule C, those get booted out of the reps test. So then we're looking at a separate test, which is, do you have material participation in that individual property? If you can say yes there, then you can use those losses to offset. The reps test, the kind of, did I work in real estate trades or businesses for 750 hours? That test is really going to look for only rental properties that are falling on Schedule E. Basically more traditional rentals.
I missed that aspect of the question.
No, I did too the first time. And so that's why I just wanted to circle back on that. Like Chet said, if you're talking more long-term rentals or traditional rentals, we've seen people with just 1 property meet the reps hours because it was, maybe it's a quadplex or whatever, or they had to do a bunch of work on it this year. Something like that. You can still hit it with just 1, but it just comes down to documenting your time and how you spent it.
Awesome. And then can I hire my kids as part of my real estate company?
Yeah, it's a great question. It's a great strategy. So the answer is yes. Yes, you can. In terms of paying your kids, it's a great strategy for basically small businesses, which most people who invest in real estate, they'll set up an LLC. That LLC is a business. And so they'll hire their kids either for administrative tasks or modeling in some cases to model for their business. This is kind of some common strategies. So some things to consider there around how do I go about doing that? What are the ramifications of that? What does that mean for funding retirement? A lot that goes into that. The other side of it is whether or not they have passive income as well. And so what strategies am I using relative to their passive income? And then how does that strategy impact it? Do they have to file a tax return? Stuff like that. But yes is the answer, the short answer.
So on that, when you hire your kids, so you get them on payroll. So you're issuing them a W-2. The benefits of that are you can pay your kid up to the standard deduction before they're going to be subject to any income tax. And so as long as you're paying them less than, the standard deduction for a single person, they're not going to be hit with any income tax. If you are paying them through a non-corporate entity, so not a C corporation or an S corporation, then you can avoid FICA and FUTA taxes on what you're paying them, assuming your kid's under the age of 18. They're not going to be subject to those payroll taxes either. So it's a really nice opportunity to get a deduction in your business for, you're probably going to give your kid that money anyways, one way or the other. So at least this gets you a deduction for it. It opens the door, like Chet said, for that kid to then set up an IRA. They can start to put money into a traditional IRA or a Roth IRA. In their case, a deductible IRA may even work. If you pay them more than the standard deduction and they use some of their money to put into a traditional IRA, deductible one, they can drive their taxable income back down and still not owe any income tax. The last thing on that, I guess I would say, is there are some hoops you may have to jump through at the state level, depending on what state you're in, to actually employ your kids. You have to get certified or make it clear that they're your children and you're eligible to employ somebody that may be under the age of 16. And then the last thing is they do have to be providing some sort of service to the company, whatever that may be. You can't just pay them to do nothing. That is an area that will get some scrutiny in the event of an audit. The IRS will question what that person was doing for the business.
Awesome. We have one more question here, but folks on the call here live with us today, feel free to drop other questions in the Q&A box and we'll get to those. But can I deduct the purchase of a car through my entity?
Yeah, good question. Yes, potentially. There's the consideration around, typically the question we get is after, should my business buy the car or should I buy it individually? General rule is if it's 95% or more used for business purposes, basically exclusively used for business purposes, you can purchase it through the business. Otherwise, just purchase it individually in your name. And then it just comes down to business use percentage. And so if I'm using the car 20% for business purposes, I'm probably only going to get a 20% deduction associated with that. So track your business miles, your total miles, and then track all of your auto expenses are kind of the things that you need to track in order to claim a deduction there. So keep receipts, keep a log in order to claim that deduction. And then there's also some strategies just around timing of the purchase and then the type of vehicle as well. So what is the vehicle, oddly, what does the vehicle weigh is a metric to which the deduction changes depending on the weight of the vehicle. Also the type of vehicle. And the reason I mentioned timing is there's things like bonus depreciation where I potentially deduct 100% of the cost. And so it may be a situation where I'm getting towards the end of the year. I know I'm going to need that new car anyways. So when I'm looking at vehicle options, I might want to consider a vehicle that I could use exclusively for business through the end of the year. Because now I'm going to get a big deduction for it. And then I'm also going to look at what type of vehicle qualifies for 100% bonus depreciation. So extreme examples, we have clients who buy a nice new vehicle. It meets the weight requirements towards the end of the year. They use it exclusively for business. They write up 100% of the cost.
Yeah, I think it's a great strategy. So that weight limit, that 6,000 pound weight limit, if you buy a vehicle in, say, December, and you use it only for business in December, you take, of the two methods you mentioned, the actual cost method opens the door for that 100% bonus depreciation. You used it only for business in that month. That year, you're going to claim that full deduction, 100% bonus depreciation. Whatever the cost of that vehicle was, new or used, you can take that as a business deduction this year. Then going forward, though, there will be no more deductions available associated with that vehicle. You've taken all of it in this year. There's the two methods: the actual cost method, where we look at what the actual costs of using that vehicle were, you can deduct those, or you can use the vehicle mileage deduction. So it's a rate per mile you can deduct this. Generally, you can optimize between the two on an annual basis. Look at the two expenses, take the higher of the two. However, if you take the actual cost method in the first year that you put that vehicle into service, going forward, you're locked into actual cost. You can't use the mileage deduction. Say all that because right now, a lot of people are buying these heavier vehicles, SUVs, trucks, so that they can get that bonus depreciation and recognize that huge cost. It does just close the door to further deductions down the road. Generally, you're still in a better place by taking that bonus depreciation. There are, like you said, different rules for luxury vehicles, which are going to be everything that weighs less than 6,000 pounds.
Yep. So conversation to have with your accountant is, hey, I'm thinking about a new vehicle. The types of questions that they should be asking are, what do you typically drive for business purposes? What does your mileage look like? What's the cost of the vehicle? What type of vehicle are we looking at? Does it qualify for any tax credits? Some vehicles do. Is it an energy efficient vehicle or plug-in, something to that effect? And then basically looking at projecting out like what's the most likely scenario in terms of how to maximize that deduction. So.
Cool. Awesome, guys. Well, those are the questions we had for today. Definitely appreciate the folks who jumped on the call. I'll send out an email blast to our list here. I imagine folks will want the recording. Typically happens. If you're on the call and if these spurred kind of any other questions, feel free to let me know and we can pop the call and discuss. Chet, Kyle, anything to add before we close out here today?
No, I think we covered it.
Cool.
Yeah, thanks so much.
Cool, guys. Thanks for your time.
All right, thanks.